From New York City for our viewers worldwide, I'm Katie Greifeld in for Scarlett Fu. Bloomberg Real Yield starts right now. Coming up, U.S. consumer sentiment hits a record low as inflation surges, the most in 4 years, on the heels of skyrocketing gasoline costs. With all eyes on peace talks between the U.S. and Iran this weekend, and global credit risk drops ahead of those talks as investors hope the ceasefire holds. We begin with the big issue, the ongoing impact of the war in the Middle East.
The increase in the month-over-month headline number was entirely attributable to gasoline prices.
It's very difficult to fathom how the next 2 weeks, let alone the next 2 months, unfold.
It's not where oil prices go, it's where they stay. That's important. How long they're at a certain level.
I think it's very viable that we stay in this price range.
The U.S. economy was relatively well positioned to withstand at least a temporary shock.
Inflation might not be as bad as feared, all things considered.
It is temporary, and then it starts to ease as the year progresses.
Situations like this highlight the resilience of the U.S. economy.
For the Fed, you can look through a particular month, particularly driven by gas prices.
We've continued to expect the Fed to cut rates.
Hikes still seem a long way off.
I don't think we should be afraid of rate hikes.
The Fed is very comfortable just sitting on its hands.
The Fed is in hibernation mode.
Well, let's talk about inflation because we actually got some data to dig into this morning at 8:30 a.m. We got CPI for the month of March, and I have it on the board behind me. That is the blue line here. We also got PCE this week as well, but that was for February, so before the start of the war. So we should zoom in on that little yellow circle here because it really tells a story. The blue line, CPI, again, for the month of March, really accelerating here. A lot of that came down to gasoline prices, but year over year, we're now looking at 3.3%. You can see PPI, you can see PCE here. They tend to track each other more or less if you take a look at a longer term relationship. So we'll see, of course, if those other lines catch up to that blue line and what that means for the Fed. Obviously, central bankers following the impact of energy prices on inflation very closely. Our very own Mike McKee, he sat down with New York Fed President John Williams earlier this week. Here's what he had to say.
I think it will directly go into headline inflation because energy prices are an important component of that. So I expect headline inflation to actually be elevated, in the middle of this year. Of course, if energy prices come back down or stabilize, then that won't add more to inflation. So right now, my view on inflation is we're looking at an inflation rate for the year as a whole of something like 2.75%. But of course, it depends what happens with energy prices.
Stuart Paul of Bloomberg Economics, he joins me at the desk now with more, with a chart in hand. Stuart, let's talk about what we got this morning because, okay, yes, gasoline prices explain a whole bunch of what we saw in March, but still, we're talking about quite an acceleration here, even if we can't explain it.
That's right. So we're talking about quite an acceleration. The chart that I have in hand focuses mostly on the 21% increase that we saw month over month in gasoline prices. Now, we know that that's what took place in March. I'm interested in what's going to be coming down the line. Because we saw that increase in the price of gasoline, we know that spending on gasoline is going to increase by about $5 to $10 billion per month while gasoline prices stay in that $4 range, in that low fours and low four handle. And the question is, where are those dollars going to come from? They're being taken out of consumers' pocketbooks, sent to gasoline retailers, to refiners, midstream and up to E&P. But it's not the case that that money just comes out of thin air. That's money that's being pulled out of spending on other more discretionary categories. So when we look at today's CPI report and we look at the core, which is a little bit more interesting than the headline, and we see fading price pressures for things like discretionary services. When we look at the preliminary April University of Michigan Consumer Sentiment Index, and we see that consumers' purchasing plans, their buying plans, are really starting to fade, we know that the effect of the war on consumers' pocketbooks is really starting to pinch. There's quite a bit of belt tightening that's already going on. And when that's the case, folks should be marking down their Q1 and Q2 real consumer spending growth forecasts.
And it's interesting because it sounds like what you're saying, we could look to bigger and more persistent divergences between what we're seeing on a headline figure when it comes to inflation and what we're seeing with core. We saw that in March, core CPI month over month coming in at just 0.2%, whereas the headline came in at 0.9%. I mean, is that the dynamic that we should expect to see while this war is still going on?
There are two effects of energy prices within the core. So in a sense, there's this mechanical upward pressure from energy prices into things like airfares. But the second effect that we need to keep in mind is exactly what you're pointing out, this divergence that we could expect that's coming from retrenching demand in a lot of the more discretionary categories. When you see hotels fading, when you see a pullback in spending on accommodation and food services, you know that retrenching demand and that decline in real economic activity is what's going to matter most. When we then think about what that means for core PCE inflation, what that means for the balance of risk for the Fed, you know that they're going to be keeping their eye on slowing real economic activity and downside growth risks.
All right, Stuart, great chart, great discussion. That is Stuart Paul of Bloomberg Economics. And let's dig into all of this now with our macro roundtable. Herr, she is U.S. CIO for Global Fixed Income, Currency, and Commodities over at JPMorgan Asset Management. And Yulia Alekseeva, she is Managing Vice President of Fixed Income over at MissionSquare, joining me at the desk. It's great to see you both to start.
It's lovely to be here, Katie.
We have a lot to talk about. So, Yulia, I'll start with you since you're closest to me. Let's start with what we saw on CPI. As expected, but you think about the rate of acceleration here. What is the risk when it comes to the bond market?
Absolutely, and I like the privilege of being close to you. I will say when we are looking at inflation print today, to us it's less about the level and more about the composition to see if that inflation is broadening. And I will say headline is an easy interpretation. We were expecting it to be an energy spike. It came at 0.6, versus the last month, so at 0.9 overall. That is volatile, but that was expected. We know that it comes through very loudly in the headline CPI number. The interesting story, to your point, is in the core and how it transmits to services, because on the goods side, the disinflation has already largely occurred. Within services, we have shelter, which we know tends to be slow, it tends to be lagging, it tends to be more backward-looking in nature. But if we look at the data today, even though there was a slight uptick month over month, on a year-over-year basis, it's decelerating, which is reassuring. If you look at the services ex-shelter, which to me is the real question, it's the core battleground for inflation, so to say, that is more challenging. It is wage-driven, it is very sticky, it's hard to bring down, and this is what Fed will look at. But the data here, even though it's moderating, it still shows stickiness. So the framework is, today, what we got is a high, very hot headline, but the Fed will look through it. That was expected. But if in the future we see a reacceleration in the core, that will be problematic, because that will suggest inflation is now becoming embedded, and that will put challenges on Fed's confidence in further disinflation path.
Right. Well, Kay, I asked you about CPI before we started, and I believe you yawned. So a little bit of a preview to your reaction.
Technically, I said ho-hum. I didn't yawn.
True.
I'm alert and awake and delighted to be here, Katie. So I think Stuart and Yulia articulated quite well exactly what we saw. But it's also, the reason I said ho-hum is it's exactly what we would have expected and completely in line with consensus. We've seen gas prices increase. I think the more interesting thing this morning is to see the University of Michigan consumer sentiment plummeting like it did. That's the lowest number we've seen since the 70s. And when you think about, when we started, we were talking about the GFC for whatever reason. Isn't that interesting to think that we've had a conflict in the Middle East that's lasted 5 weeks roughly, and that's been adequate to take consumer sentiment to levels that we haven't seen since the 70s?
Yeah. Well, it's fascinating. I mean, you think about sentiment. I feel like the story of the economy and the consumer over the past several years, especially during pandemic times, was, okay, people are miserable, but they're still spending money. And I wonder, if there could be a this time is different sort of scenario, since now you do have energy prices increasing at a very dramatic clip. And I mean, you take a look at consensus, and it says that, these ripple effects, even if the situation is resolved quickly, they could be around for a while.
So Katie, it's jobs. When the consumer is employed, he or she continues to spend. So it's that simple. And when, to pick up on a couple of points that Yulia made that I think are really critical about the inflation numbers are what's happening with wage inflation and what's happening with shelter inflation. Those two so far have been very muted. But if the consumer remains employed, sentiment will fall. I think the other thing that's really interesting is that if we think about the initial conflict, and we can talk a little about on real yield about bonds here,
yes.
But the initial conflict, it sent the 10-year Treasury, or 2-year in particular, were not the risk-free assets that sometimes people expect them to be. Because interestingly, the market reacted to inflation and the expectations where the market went from, the Fed's going to cut twice to the Fed's going to hike. And to the point that Yulia made, it seems a little premature to not consider what Stuart touched on is what is the consumer's reaction?
Yeah.
We change our behaviors. If you're paying more for gasoline, there's less money in your pocket, so you're going to change your behavior. And I think that's really important to look at, and it's how the economy overall unfolds more broadly.
And Yulia, weigh in on that point, sort of the portfolio implications here, because it has been a head scratcher over the past month, especially, really in the thick of fighting to see bond yields just accelerating, particularly at the long end. What do you make of that sort of knee-jerk reaction, that impulse?
Yeah, Katie, from a rates perspective, I would say we are now in a more fragile equilibrium. So on the front end, we're anchored to the Fed being on hold, and we're likely going to be hostage to more data in the near term. And then on the other hand, on the long end, we are driven by inflation expectations, by oil, and by term premium. So we're likely going to stay elevated, sticky, and range-bound. I think the more interesting point to make is that the markets are now adapting to this world where we have shocks that are more persistent, shocks that are overlapping, and shocks that are less mean reverting in nature. And what that supports is a structurally higher macro volatility and a structurally higher term premium, particularly further out the curve. So practically speaking, it has two implications for the bond markets. One is higher for longer, it's here to stay, whether we like it or not. And then the second one is that there's probably more bias towards gradual curve steepening. So from a portfolio positioning perspective, we at MissionSquare think that duration right now is not the place to lean in. We are a little bit more constructive on it than at the start of the year. We still like the front end more as a better risk reward because we are expecting more rate volatility ahead.
It's fascinating because I've been hearing that for years at this point, that it's the front end that looks most attractive when you take a look along the curve. And to go to extremes, you take a look at money market funds. They just can't turn away money at this point. It just keeps funneling in. And, Kay, I wonder what is the case against cash, or is there just not one right now?
I've got a comment first on term premium. One of my colleagues jokes that term premium is the term that economists and the like use to explain when they don't understand why rates are where they are. So I'm like, I don't know that I'm in the higher for longer camp, but you make a great point about money markets. And what is it? There's $8 trillion in U.S. money markets. But I think we also have to look at what credit markets have done in this period. So, we've had conflict, we've had an inflation shock, a supply-side shock here, and essentially IG spreads have round-tripped the widening we saw. They were 15, 20 basis wider. They're back to where they were initially, so low 80s, maybe even high 70s after today. Similarly, on high yield spreads, those widened 100 basis points and are now back into where we are. So broadly, credit markets are unchanged. And I think one of the reasons for that, Katie, is that you see demand. So we have seen consistent demand. And when you look at fixed income yielding 5.5%, look at the IG market. It priced something like $35 billion this week in a volatile week where you think people are watching Truth Social, they're watching the peace environment unfold and all this.
And also Bloomberg TV.
And Bloomberg TV,
yes.
You're right. Well, actually, some of us read True Social on Bloomberg, just to be clear.
That's true.
So I sort of implied that. But people are gripped at their Bloomberg screens to find out what's the update on peace talks, et cetera. And you can still price $35 billion in the IG market this week. And you look at the concessions, it's like 4 basis points worth of new issue concessions. And these deals are 4 times oversubscribed. So I think we have to look at, demand is strong, demand is there, and real yields and nominal yields are attractive, and people are seeing the opportunity. You know, I've had several client meetings in New York in the office at 270 this week, and people are asking exactly that, about increasing their allocations to fixed income, about where they want to be on the curve, and blending short core and core assets, and I think that's really a sweet spot in there.
Maybe to build upon what Kay just said, I do think that fixed income is now doing what it's supposed to do. We have income and we have downside protection, which is becoming increasingly important in a volatile environment like today. On the income side, we now have higher starting yields, so they are providing a more compelling entry point. There was a little bit of a widening, which I think you could have potentially capitalized on.
Exactly.
And then on the downside protection, I think, to your point, credit markets have been extremely resilient. And when I compare them to what happened in the equity markets, it once again supports the case for fixed income. I'm somewhat biased, but I will not advocate for broad-based risk-taking here. I will say it's still a market that needs to be very disciplined, that needs to be very selective, because we are seeing rising dispersion, and we're still seeing spreads that are tight versus historicals, so that lowers our margin for error.
All right, guys, it feels like we're just getting started.
I know,
I'll give you the very last word, 15 seconds.
No, I was just going to say, I think what's going to be really interesting is that U.S. earnings season kicks off next week.
Yeah.
And what will be interesting to see is if the attention migrates to bottom-up fundamentals and corporates, because I think consensus earnings are something for like 16% growth this year.
Yeah.
I think that's really what's going to define credit spreads from here, and I think that's more relevant.
Yeah, it's a great point. I mean, you take a look at earnings estimates, also resilient, but also in some cases marching higher as well. So enjoyed this conversation. Thank you to you both. That is Kay Herr of JPMorgan Asset Management and Yulia Alekseeva of MissionSquare. Now, still ahead, a moment of interest where we take a look at why some private credit fund managers are capping redemptions. That conversation next. This is Real Yield. It's time to see what's of interest. Concerns intensifying over the private credit market's exposure to software. Earlier this week, I spoke with Marathon's Bruce Richards, who issued a warning about direct lending in software.
The reason why you have to stay away?
Yeah.
The default rate is going to go to, mark my words, 15%.
In software.
In software specifically, for DL managers, 15%. And it won't be 15% 1 year. It'll be double-digit default rates for 3 straight years, I believe. And so it's going to be massive.
And investors are already rushing to yank billions of dollars from private credit vehicles run by managers from Blue Owl to Carlyle. For more on this, we're joined by 2 reporters who've been covering this space. They are Bloomberg's Olivia Fishlow and Aaron Weinman. Great to have you both. Aaron, I'm going to start with you since we just heard from Bruce Richards with some very scary words. And you wrote a very scary headline this week that private market software pain is about to get a lot worse. How much worse, Aaron?
I didn't write that headline, actually.
It's always the editor.
No. I mean, it's not my byline, but that's neither here or there. But I think from reading that article, my understanding is that 2028 is looming as a pretty high wall for maturities. So what's going to sort of play out between now and then is the hope that the market opens and enables borrowers to refinance their debt or just kick the can down the road a little bit further for those companies. What I think is going to be helpful for investors in determining the answer to whether they can refinance is what earnings will look like for these businesses in the coming quarters. Why I bring that up is because software businesses in particular will be able to show investors how impacted they are or are not by burgeoning AI tools.
And Olivia, I mean, against that backdrop, how does that sort of fit into what we're seeing when it comes to the redemption side? Is that more psychological, or have you been able to connect the dots that folks are worried about software and they're trying to get their money out?
Definitely, yeah. So what we're seeing is investors do seem to be worried about software, but at the same time, it is psychological in a way where they haven't really seen an impact to the portfolio yet. It's more of sort of the fear of, look, these private credit funds are pretty heavily invested in software. These businesses could or will be impacted by AI, and the investors just don't feel comfortable with that risk. But again, they're not really sure, and no one is really sure what will happen.
And at this point, I mean, who are we still waiting to hear from when it comes to redemption requests? Obviously, Carlyle drew a lot of eyeballs this week, but who has yet to take the stage and say, you know, this is what we received this quarter?
So we've seen most of the large funds report, but then of course they have to reopen the tender windows soon. So I think what we're waiting for is sort of a longer period of maybe a year or so where there's elevated redemptions for these funds.
And Aaron, I mean, I'm curious, you know, what people are saying about how this evolves in the future, because, okay, we're getting through this quarter, but what does the coming quarter look like? What does the quarter after that look like?
Yeah. So as I mentioned earlier, I think what's important to gauge is how revenue and EBITDA will look in the coming quarters. How much can businesses utilize artificial intelligence tools to, say, cut their expenses? And secondly to that is, will this war come to a more conclusive end that will then determine whether or not the markets are likely to open and enable borrowers to come and refinance upcoming maturities, whether that's in high-yield bonds or loans. I think it's clear they're going to have to spend maybe a bit more on borrowing costs, or pay higher borrowing costs to get that refinanced. But in the interest of pushing that maturity wall further away from them, that will be important.
Yeah, it's a great point that, you know, it's not just what we're talking about when it comes to the SaaS apocalypse. You also have these geopolitical sort of macro concerns weighing on the space as well. Great conversation with you both. Our thanks to Bloomberg's Olivia Fishlow and Aaron Weinman. Now, still ahead, it's our credit roundtable. We'll speak to Peter Cecchini of Axonic Capital and Neha Khoda of Bank of America Securities. Geez Louise, this is Real Yield on Bloomberg.
Happy Friday, I'm Nora Melinda. Let's take a look at your midday movers. First up, U.S. equities are mixed, but still on track for their best week since May, as Wall Street digests inflation data that came in largely in line with expectations. Investors are also bracing for upcoming talks between the U.S. and Iran, negotiations that could shape the path forward for what remains a fragile ceasefire. Meanwhile, oil is trading modestly higher, with the conflict in Iran prompting U.S. states to consider temporary fuel tax cuts. The relief measures already approved or proposed in states like Indiana, Georgia, and Utah could cost governments millions in lost revenue. And in individual company news, ServiceNow shares are tumbling to their lowest level in 3 years. That's after renewed concerns around AI competition weighing on sentiment. UBS downgrading the stock to neutral from buy. Those are your midday movers. I'm Nora Melinda.
I'm Katie Greifeld. This is Bloomberg Real Yield. It's time now for the auction block, where we highlight the big credit issuance of the week. Now, we saw volume pick up across the board, and we start with U.S. high grade. Major foreign banks leading sales, names like Mizuho, Mitsubishi, and Santander. Total sales of more than $35 billion, easily passing estimates. Now, over in Europe, Thursday was the busiest day in a month as a wave of deals hit the market. Today was also the busiest Friday since January. Overall, there was nearly 41 billion euros in volume. And CoreWeave was in the news a lot this week. They also had a junk debt sale here in the U.S., and that offering was upsized and had strong demand. Now, sticking with credit, some investors see ongoing signs of durability despite war across the Middle East and ongoing private credit concerns.
The one thing that's been super impressive is the credit markets are extremely resilient. And I will say, you know, we've done some managing of the risk in our portfolios, and we are, you know, us and I'm sure others have built a lot of cash in a portfolio to get through what is a risky period. The credit markets, the high yield market, but it's been pretty resilient relative to what's happening in private credit.
Now let's dig into all of this with our credit roundtable. Peter Cecchini, he is principal at Axonic Capital, and Neha Khoda, head of U.S. credit strategy over at Bank of America Securities, joining me now. And Peter, we both went to Haverford College, so I'm going to start with you because, of course, when you think about the credit markets, we were just discussing with some of our reporters, there is a lot going on when it comes to cross currents coming from the Middle East. And then, of course, you have earnings next week. And then, of course, you have what's going on with the U.S. economy and given that we got inflation data at 8:30 a.m. this morning, I'd love to hear how you're making sense of all of it.
There is an awful lot going on, lots of cross currents. And the good news for selective credit investors is that there's an awful lot of dispersion occurring within the markets and across asset classes, which creates opportunity. So, chaos does tend to create opportunity for those who are focused on fundamental opportunity and dislocations to intrinsic value. And we're really starting to see that in across credit markets, in particular in high yield, less so in high grade, and in structured credit, where we have our core expertise as well. And we're seeing structured credit continues to trade at a spread advantage to corporate high yield, even with the widening we're seeing in high yield. So this very interesting period of time, I believe, is making for fertile investment opportunities for credit investors.
Well, Neha, weigh in here because, I mean, you do think about the landscape, and certainly there's a lot you could get worked up about, not necessarily seeing that in credit spreads, but where are you seeing the opportunity right now?
Yeah, there's plenty to sort through. Well, first of all, to Rick's point, credit markets are resilient, and I think there's one word that encapsulates the mentality is attractive yields. Because yields are attractive, so spreads are less concerning. We have spreads at 5th percentile. It doesn't matter because IG yields, give or take, 85th percentile relative to history. So as long as we see attractive yields and the incremental dollar coming from total return investors, we think that the demand in the credit landscape will remain strong. In terms of opportunities, we came into the year on the defensive because we thought AI obsolescence risk was real and it could create disintermediation and dispersion. And so we stick with that call of being down in duration, high in quality, and expect lots of duration.
Interesting.
Dispersion.
And I mean, with that in mind, what do you make of all the issuance, Neha, that's coming through when it comes to the hyperscalers? Because, they've been entering the market and stepping up in a big way when it comes to overall issuance.
Yeah, I mean, that's the spotlight. I mean, that's really where all the issuance in the credit market is really coming from. In the left-fin space, everybody was expecting this big M&A wave that didn't really materialize given how many tail risks are slowly bubbling up. But in the IG space, because yields are attractive, there's plenty of demand, and there's also a lot of supply. So it's kind of like a happy marriage right now. We expect about $175 billion in hyperscaler supply for this year, which should taper down, all things equal, next year.
And Peter, you mentioned that you are looking at high yield here. That's, where you see some fertile opportunities, not necessarily capturing what's going on with the hyperscalers there. So talk us through, what you're seeing when it comes to that part of the market and, what exactly is the catalyst for high yield at this point?
Well, for example, the private credit story has led to some baby with the bathwater situations, in particular in BDCs. We were not constructive on BDCs for a very long period of time because, frankly, we believe that many of them were aggressively marking their books and that there was a lot of binary downgrade risk to their portfolios. And we've seen that. Now we're seeing some BDC names, trading at 50 or 60 cents of book value. And we're giving those a long, hard look. We're also seeing some widening in the areas of structured credit that are very interesting in the single asset, single borrower market, for example, on the CMBS side. So there's been some really interesting opportunities starting to present itself, whereas we did not like the risk reward asymmetry or lack of asymmetry, call it 5 to 6 months ago, and pretty much everything had correlated to become very, very tight.
I have to seize on what you're saying about BDCs here, giving them a long, hard look in your words. What exactly does that look like? What does that due diligence process look like on your end?
Well, it's very important to look at things under the hood and look at loans on a loan-by-loan basis and understand the borrowers. Understand, for example, whether a loan on the books of one BDC is marked in the same way that the loan is marked on other BDCs' books or in CLOs that may hold the same broadly syndicated loan. And so that's a really important part of our analysis. And of course, we also look at valuation, which is quite important. We look at the manager. That's quite important. What's their track record? How aggressive are they? And we look at the sector exposure, of course. And in our private lending business, we've fortunately stayed away from SaaS businesses for the exact reason that they've been hit so hard, which is that we believe that AI disintermediation was real, and believe it probably still hasn't fully played out.
And Neha, when it comes to what we're seeing with BDCs, we were just talking about it with our reporter roundtable that, okay, you think about some of the redemption requests that we've seen this quarter, they've been staggering, but that's just one quarter. We have another quarter after this one, another quarter after that one. I mean, how are you thinking that story unfolds as we progress further into this year?
Yeah, it's multiple layers of complexity, I would say. We turned negative on the private credit space about September of last year because we were seeing some cyclical turning points amongst BDC books. And I think what a lot of people did not appreciate is the redemption part. So that's the added layer of complexity. Of course, all of this is coming from the AI obsolescence risk and the tilt of BDCs towards software. But I think, Q1, we saw the net inflows in BDCs turn negative for the first time in the history of BDC, unlisted BDC flows. And I think that's not going to be the first time. We're going to see multiple quarters of that. The upshot is that it will take several quarters of 5% redemption caps being met before this liquidity strain can turn into any kind of credit strain. So I think that's one. And the other thing, too, to keep in mind, really importantly, is that the focal point of all this angst is really the unlisted BDC, and particularly the equity portion of the unlisted BDC space. And if you do the numbers like we have, it's about 15% give or take of the overall private credit space. So I like to think of it as there's going to be very high dispersion. There will be a lot of bumps along the road. But is this something that is systemic risk and will throw or like derail credit space? Likely not.
So likely not systemic here in nature, but you think about these redemptions, if we do get several quarters of 5% redemptions for a lot of these portfolios, what does that mean for the remaining portfolio? Because, you have to imagine, or you could imagine, that they're selling the most liquid things first, and the most liquid things tend to be the highest quality things.
Yeah, absolutely right. So there's multiple stages. We actually call this 5 stages of grief for BDCs. But then if you look at the first few ways they can do liquidity management, it's on cash balance and liquid cash revolvers. They also can use incoming cash from their rollovers and not really grow the portfolio. And it's really then after they've exhausted all of that, all of those stages, then we think about par sales. And to your point, high quality sales, which doesn't present them a hit. Luckily, when we do the analysis, the overlap between broadly syndicated loans, which happen to be on BDCs, is not very huge. It's give or take about $35 billion of BSL loans on BDC books. So direct hit from BDCs to public credit is going to remain small. It's really the indirect sentiment hit that we worry about a lot more. What does it mean for sentiment if BDCs start doing, par sales or, in the worst case scenario, distress sales?
Unfortunately, guys, have to leave it there. Really appreciate you both joining our Credit Roundtable this show. That is Peter Cecchini of Axonic Capital and Neha Khoda of Bank of America Securities. Now, still ahead, Moody's is hitting the big easy with a hard downgrade for the second time this year due to concerns on rising credit risk. We'll take a closer look in our Muni moment next. This is Bloomberg Real Yield.
Happy Friday. We're just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. First up, U.S. equities are mixed, but still on track for their best week since November, as Wall Street digests inflation data that came in largely in line with expectations. Investors are also bracing for upcoming talks between the U.S. and Iran, negotiations that could shape the path forward for what remains a fragile ceasefire. In company news, Palo Alto Networks is leading another dramatic sell-off in software stocks. Investors are concerned that the forthcoming Anthropic Mythos model could re-architect the whole enterprise software stack. Meanwhile, Lumentum shares are rising after the NVIDIA-backed company said demand from the biggest U.S. tech companies for its optical components is accelerating, with the firm on track to fill its order books through 2028. NVIDIA shares are climbing as well. And finally, CoreWeave shares are soaring for double-digit gains. That's after Anthropic agreed to use the company's data center capacity to handle increasing demand for its AI services. CoreWeave CEO Michael Intrater was on Bloomberg Technology earlier today, where he talked about his company's plans to raise debt. Take a listen.
We go out and we execute a contract like the one we just did with Meta. And now with that contract in hand, we will go into the capital markets and we will raise debt that will be at a very low cost of capital to be able to build the infrastructure to deliver on that contract. Each of our contracts are profitable and drive wonderful return.
Those are your midday movers. I'm Nora Melinda.
All right, it's time now for our Muni moment, and we have two stories to cover this week. The first is anxiety in private credit is starting to impact a segment of the debt market called prepaid energy bonds, which allows municipal utilities to buy electricity or natural gas at a discount. Now, some of those bonds are weakening more than benchmark munis as supply-demand soars. Bloomberg's Aaron Hudson joins us now. So the muni market, not naturally the first place you would look for private credit impact, but talk us through the relationship here and what we're actually starting to see develop.
Yeah, so the reason that there's a spillover in private credit concerns into munis is due to a very fast-growing sector of the muni market called prepaid energy bonds. And these bonds are very complicated transactions that rely on a middleman. And this middleman role is, what they do is they receive the proceeds of the muni bonds up front, and then they're able to take that onto their balance sheet and invest it in exchange for making fixed monthly payments that go towards procuring the energy that goes to the municipal utility to buy at that discounted price.
So, yeah, certainly a complex sort of daisy chain there.
Yes, yes. And traditionally, that middleman role has been filled in by banks, but insurance companies like Athene are increasingly stepping into those roles. And that's where we're seeing the connection to private credit come into it, looking at Athene's portfolio, and of course, its connection to its owner, Apollo Global Management.
Well, I was going to ask, I mean, what are investors specifically worried about when it comes to Athene there? Is it the Apollo portion of it, or is it something else?
It's a bit of both. It's about Athene's own portfolio and the potential losses for its own private credit investments, and then also the exposure through Apollo. So that's what we're hearing from investors. Athene says that the spread performance is not indicative of the strength of its balance sheet or the credit quality of its portfolios, and there are independent analysts who echo that feeling. But investors see it differently, and that's coming through in the spread prices.
Well, Aaron, great reporting following this story for us. That is Bloomberg's Aaron Hudson. And let's stick with Moody's, because another big story out this week. S&P Global has dropped its credit rating on New Orleans as the city confronts one of the worst financial crises in its modern history. Now, the ratings firm cited the city's heavy dependence on one-time financial fixes and shrinking liquidity as reasons for the cut. Bloomberg Muni finance reporter Ashna Shah is covering the story, and she joins us now. So it sounds like this was theoretically a long time in the making when it comes to this drop for New Orleans here.
New Orleans has been facing years of financial distress, and as S&P cited in their report, they have structural and operational imbalances, their reserves are depleting, and they're relying heavily on these one-time temporary fixes, which I think is the main thing here. They're furloughing employees, they're relying on a $125 million payroll loan to just meet payroll. They're putting a hiring freeze in process, and so they're really relying on this one-time temporary fix, and that's what S&P wants them to pull back on.
And I was going to ask, I mean, you think about, this change that S&P put through this week. What did they say about what they would want to see, what they need to see for them to, consider changing the outlook or the rating eventually?
They want New Orleans to essentially fix their balance sheet. And so once they start seeing that, once they start seeing less reliance on these one-time fixes and other ways to fill these budget gaps, and a lot of this was caused because they spend a lot of the money from the federal pandemic aid, and they used it to prop up their budget, to prop up day-to-day expenses. And so now they have to get creative and find ways to fill these budget gaps.
And what does this mean for investors, the fact that you did see this drop when it comes to the New Orleans credit rating?
It definitely makes investors a little bit nervous, but I think once S&P decides whether in the next 2 years, they're going to downgrade it further, change the outlook to stable, I think investors are going to be keeping a close attention to that, and so will we.
And is it safe to say that, a lot of these issues that we're talking about are idiosyncratic to New Orleans, or are we seeing, other cities around the country sort of confront similar problems here?
We're seeing a lot of municipalities facing the end of pandemic relief aid and how they're coping with the lack of this aid and filling their budgets in other ways. And so we're seeing cities across the country find different ways to plug these budget gaps.
All right. Really enjoyed this story. Appreciate you reporting that. As Bloomberg's Ashna Shah. Now, still ahead, it's the final spread. The week ahead, we have big bank earnings on a deck, along with a major IMF meeting. This is Bloomberg Real Yield. I'm Katie Greifeld. This is Bloomberg Real Yield. It's time now for the final spread. The week ahead, coming up Saturday, the U.S. and Iran hold peace talks in Pakistan. That brings us to Monday, when the IMF spring meetings begin. We'll also get earnings from Goldman Sachs, kicking off the season in earnest. And then Tuesday, that's when things really heat up when it comes to the banks, with JPMorgan, Wells Fargo, and Citi all report. Plus, we'll get more inflation data ahead with U.S. PPI. And then Wednesday, it's tax day here in the U.S. And we also see bank earnings continue with Bank of America and with Wells Fargo. Thursday, Netflix earnings and a G20 Finman meeting. And then Friday, it's Boeing's annual meeting. And we'll also get some Eurozone trade data. Now, for the final thought, let's take a closer look at next week's IMF meetings with Bloomberg's Reed Pickard, who is in Washington, where those meetings will be held. So, Reed, great to have you with us. I mean, what is the expectation? I have to imagine a lot of the conversation will be about what's happening in the Middle East and what the impacts are.
That's certainly the expectation. So what we've heard from the head of the IMF this week is that not only will these talks be happening, but the IMF will obviously be releasing their updated world economic outlook. Heading into this meeting before the war, the expectation is that growth estimates for the year were actually going to be revised up. But now with the war, Georgieva said that those expectations are now for lower growth this year than they previously estimated. And so we're looking forward to seeing those and seeing how the various member countries, 191 countries, how they are thinking about this, seeing what's happening on the sidelines in terms of the conversations about what the future may look like, and how these disruptions that we've seen in supply chains globally, whether that be oil or key minerals and things like helium, how that's impacting economies across the globe.
And of course, there will be central bankers in attendance, including one, Christine Lagarde. And Reed, we only have about a minute left, but you have to imagine that a lot of those central bankers are in very tricky spots right now. You think about the expectation for slower, lower growth, at the same time, potential inflation pressures as well.
Absolutely. And I think you're seeing that play out across the globe. At least here in the U.S., we've seen that the Fed is really trying to balance the fact that this shock could mean both lower growth as well as higher inflation, like we saw today. And it's still kind of a question of where things go from here. We saw the head of the World Bank say yesterday that, at least in emerging market economies, the focus should be on inflation first and then growth. So far in the U.S., it's been more of a wait and see by Fed officials. Today's data, for instance, showed that the overall CPI increased a lot due to gasoline. But the so-called core measure, which strips out energy and food and is something that Federal Reserve officials look to see where inflation may be heading, was actually much tamer. So still in this wait and see posture, and we're looking forward to seeing what policymakers from around the globe are feeling about that right now.
All right, Bloomberg's Reed Pickard with the IMF preview here. Now from New York, That does it for us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.